الوضع الاقتصادي العالمي خلال العام القادم، ويشرفنا في الجمعية الاقتصادية اليوم نستضيف الدكتور نانت الهيد اوف ريسيرش اند ايكونومست في كريدت سويس، اللي راح تبين شنو اوجه التحديات الاقتصادية اللي راح تواجه العالم خلال العام القادم من باب الدراسات والسياسات. طبعا واجهت الاقتصاد العالمي خلال عام 2019 دخل فيه العديد من نسميها المفاجآت الاقتصادية، منها البريكزيت في بريطانيا والحرب التجارية اللي بين الاقتصاد الأمريكي والصيني، وكذلك العديد من التحديات اللي واجهت الاقتصاديات في أوروبا. اليوم عندنا مع الدكتورة راح تتكلم in general عن الوضع الاقتصادي بشكل عام. Welcome Dr. Nant in Kuwait Economic Society. It's a pleasure to have you here with us today and it's your time.
Thank you so much. I will stand up while presenting to you. I feel more comfortable being up, and then I will join you again for the discussion. So, Madam, gentlemen, we are coming to the end of a year that I remember at the beginning. Everybody was very worried about how 2019 would be panning out. And even in summer of this year, the word recession, if you would be Googling for the word recession, it would have hit a high by the month of August. If we had not known there was a trade conflict going on for the whole year between the United States and China, well, financial markets certainly would have told us something very different. This is a selection of assets across all categories: bonds, equities, alternative investments, commodities. And the key in this graph, which is showing you the performance since the beginning of the year, is that practically for everything, the bar is on the right-hand side of zero. About everything has been doing really well, from core government bonds all the way to equities. One of the equity markets considered the most defensive and the most boring, which is the one of my home country, the Swiss equity market, up by nearly 30% since the beginning of the year. By all accounts, this has been an exceptional financial market year. Of course, there is a way to square at the same time the difficulty that we have been seeing in sectors, in countries, for example, in Europe, in Germany, and the very good performances of the market. And what is squaring this apparent inconsistency is the fact that over the last nearly 12 months, interest rates and bond yields have come down. In the US, for the 10-year US Treasury, this is nearly a total of 100 basis points, or a full percentage point, and it is the upper line here of this chart. And of course, it has precipitated bond yield declines around the world, which explain the fact that all these performances were shored up because of this impact of declining yields. So today, I have the opportunity to travel across practically the world, certainly in the EMEA region, from Europe all the way to the Middle East, Russia, etc., and Asia. And the questions that I am receiving from people is there a degree of complacency in financial markets at the moment, and how do we at Credit Suisse think of recession risk? Where would it come from, and what is the likelihood? And if I said in the beginning, a lot of the performances that we saw this year were explained to a large extent by the movement of bond yields, what happens next year? Where are bond yields headed? And as a result, what do we expect of equity markets in particular, or risk assets more generally? And how to position as investors? These are about the questions that I receive the most after such a staggering financial market year. So we are here after all in the economic society, and let me start with a few comments on the global economy and explain to you why we in our bank do not expect a recession, but certainly do expect very moderate, I would say sluggish, global growth in 2020. By all means, there is one sector that has been impacted very tangibly by the trade conflict between the United States and China, and that's the manufacturing sector. If you take a look at this chart here, it is actually showing you purchasing manager indices, which are good business sentiment leading indicators, and the manufacturing PMI for the global economy has been on a downward trend since now, in fact, 2 years, more or less. And when we look at, however, where it was at a time of past recession, there is simply no comparison between the slowdown that we have been experiencing recently and the financial crisis, the great financial crisis in 2009 and started in 2008. But also, if this chart was going and stretching more longer, it would also not be comparable to what we had during the tech bubble burst in 2001. So yes, manufacturing has been rattled by the US-China trade conflict, but it is in a very different place than where it would be when we had recessionary circumstances. Also, what I really want to point out here, because it is an important explanatory variable of why we don't expect really a negative economic scenario, is that services, to the difference of manufacturing, have been holding up very well. And when you look at the global PMI and how much services these days represent compared to manufacturing, then actually global businesses are increasingly dependent on what services do rather than manufacturing. So that's the first point to say. There is a big discrepancy between manufacturing that has been negatively affected and services much less. There is one economic area that is particularly exposed to manufacturing, and that's the Eurozone. Not only is it because a very important country in the Eurozone, Germany, by its economic weight, is a very export-driven country. Exports represent more than 50% of GDP in Germany. But also is it an economic area that is very exposed to industrial production. You can take a look, for example, at the equity index of Europe, and you will see how much the weight of industry is as opposed to technology, which is completely the reverse in, for example, the United States. And moreover, Germany and the Eurozone are particularly exposed not only to exports, to industrial production, but more specifically to autos. And the auto sector, the automobile sector, has always been a very important transmission sector for the global economy. So there is for sure one economic area that is most affected among all, and that's been the Eurozone. If I take it to the extreme, I could say the Eurozone has paid the price, the economic price of the trade conflict between the US and China. And interestingly, I mean, this is a chart that many of the peripheral Eurozone countries love. The audiences, when I go to Greece or Spain or Portugal, love to see this one. it is showing you how the European Commission has gradually revised their growth expectations between sometime late 2018 and this year about 2019 growth. And what it's showing you is that effectively here, Germany most negatively impacted. The European Commission had to cut and revise down repeatedly their growth estimates for this year as the trade conflict was going on and impacting this economy more. And then you can see that now Germany is in fact here in good company of Italy, the one country that was considered in some sense, stagnation. And how the periphery, but also countries like France, for example, have been much less impacted. And in fact, in Greece, and I am coming back from a trip to Greece a few weeks ago, they were actually this time around really very pleased that this particular chart themselves experiencing growth upgrades in terms of how their economy has been doing. The key message that I want to give you here is that the Eurozone, although it is negatively impacted by trade, probably by far the most, when I compare that regionally, is also not a homogeneous, it's not a homogeneous region. And the one country that is suffering is Germany, but the others really are much less. They are also less exposed. And so even the Eurozone is probably not going to face a recession because of this disparity. And I'll go through a few numbers a little bit afterwards. Let me now come to the two countries that actually started the whole trade conflict and talk to you first about China. On the left-hand side here, you're seeing a graph of GDP growth in China over the last 15 years or so, and how it was made up. And when you look at the axis and the numbers here, yeah, the trend has been down. So China every year has been growing less and less than before, but we are still growing at 6%. So there is no question of a recession. I wouldn't even know how to define a recession in China. There has never been negative growth in China. But there is very clearly an economic transformation that is very structural going on, not only this year, but also already a few years ago, and it will continue also for years to come. And that is the transformation of the Chinese economy from an industrial and export-oriented economy, a little bit like the German model that I discussed before, into a consumer and service-led economy, which is a little bit what the United States is. So the Chinese authorities are very focused on transforming their economy from this one past model to the next future model, a consumer-led economy. And what this means is that, yeah, consumption in percent of GDP in terms of its contribution is going to increase over time. It has already increased quite significantly from below 40% to now more like what all developed economies are having, about 60% of GDP contribution. And what happens with such a transformation is that growth rates tend to come down. That has happened in every industrial nation before China the last 100 years, and will always proceed with exactly the same pattern. So we should not be worried that China is growing at 6% and perhaps next year at a little bit below 6% and perhaps in the next 5 years at 5 or 5.5%. That's part of what China is actually targeting in terms of structural change in its economy. Of course, it will have to support that transformation very actively. It is cutting reserve requirements. for example, when the private sector is going through a phase of weakness, it is using credit growth, it is using fiscal expansion absolutely when the private sector is not strong enough to deliver what growth rates they are targeting. But also, I would say, in China, it is a centrally planned economy. So if they say they're going to grow at 6% or 5.9%, they will just grow at that rate, and they will do everything it takes to get there. In particular, one of the adjustment variables that I think economists, businessmen, as well as investors should realize that this is one of the adjustment variables in order to get to the 5.96% growth that they're targeting is the currency. In fact, if you take a look at this exchange rate, which is just simply the renminbi compared to the US dollar over time, then you can really see what happened during the escalation phases of the trade conflict in the course of the last 18 months. Every time the United States was increasing or expanding its tariff threats, renminbi depreciated by about as much. And so in the end, prices of many of the Chinese goods that are flowing into the United States in the form of exports, priced in US dollars, did not change really very much. And so it is also not so much of a surprise to see the trade deficit between the US and China not having changed, in fact, probably having even deteriorated. So that's because China has to, of course, adjust a few variables when it wants to create the growth rate that it is targeting. And I would say it is more uncertain what is the outlook of the renminbi than what is the outlook of growth in China. Let me speak to the United States. Now, this is the other side of the trade conflict. And the United States is this, when you take it from an economic standpoint, it's this very large economy that is predominantly dependent on its own private consumer. And the own private consumer in the United States is having a fantastic labor market in the back. This is what you're seeing on this slide, with two variables of the labor market, one being the unemployment rate and the other one being wages. The unemployment rate is currently still around 3.7%. By historical accounts, this is even below what we would consider full employment in the States, more like 5% type of unemployment rates. And so in such a tight labor market as we have at the moment, it is not a surprise that wages have finally started increasing, thereby creating a situation for US private consumers where not only do they have access to jobs, even having labor participation going up, so people that were outside of the labor market being able to come back to the labor market, but also do they have more purchasing power because the wages are starting to increase. That is very difficult to create a recession in such an economy where 70% of GDP is being contributed by consumers that have this type of positive labor markets to support them. So although we are certainly not counting already historically for growth rates comparable to those in China, but the United States is likely to grow at around 2% also next year, keeping conditions for a very sustained and very resilient economy. So that, ladies and gentlemen, is explaining why I do, and we at Credit Suisse have been among those that consistently did not expect recession risk to be really that high, just by taking, in some sense, the math of growth and understanding where and how growth is generated, I know many of you like to have a couple of numbers to reflect what we mean by no recession but moderate growth. So for the global economy, it would mean a growth rate in real terms of about 2.5% in 2020. This compares to the past, where global growth tended to be above 3%, where the United States are likely to grow with 1.8%, close to potential growth next year. The Eurozone more negatively affected, half as much, about 1%, and where this time around the tail end of the growth spectrum in the Eurozone is going to include for the first time Germany among those. On the other side, in emerging markets, still a very good picture with China. Note perhaps here that China, for the first time in our view, is also going to more formally expect growth and plan for growth to be for the first time below 6% in 2020. This is likely to be the initiation of a trend. We do believe at the beginning they are likely to keep it around 5.8, 5.9, but over time it's likely to come down towards 5.5%. And even countries that were in a tough spot, like Turkey, for example, this year, as it came out of this currency crisis that struck the country last year, is likely to rebound really quite strongly. We had initially anticipated first a bit more than 2%, but our economist has even had to revise that up, and we are now expecting Turkish growth rate at above 3% next year. So really, the one country of size in emerging markets that is among the few ones that will be having a negative growth rate remains Argentina, and the rest, ladies and gentlemen, is likely to grow into the next year. Now, I am here in the region, and this is a region that is very much a cyclical, of course, region because of its ties with the whole oil sector and because of the cyclicality of that particular sector. And so it is good news for the region that the global economy is not going into a negative scenario and that it is continuing to grow, because when there has been this trade conflict and the slowdown that we experienced in the global economy, well, this has translated also in slowdown here in the region. What we are seeing here is how actually forecasts for the Middle East economies on average had to be revised down in the course of the year for 2020. And we believe that it's likely to in some sense find a stable bottom at these levels here, so slightly above 2.5% for the whole of the Middle East. It is also a fact that many economies have had to support their growth in the region here with fiscal spending. And I am speaking to you, an audience of a country that has not followed suit with the US interest rate cuts, where real interest rates are still very high compared to the rest of the region. And I do expect that in the coming year there is likely to be also some cuts by the central bank in order to reflect the economic situation in the region and in Kuwait more specifically. So let me now come to discuss how we think of financial markets going forward with that type of economic outlook in the back. No recession, moderate growth, and central banks that would likely leave their monetary policy very accommodative, because let's not forget it. In the United States, we have an electoral year where the election campaign is likely to be extremely polarized. It is very unlikely that the Federal Reserve will do anything before the US elections are past. If it was to do anything, it would certainly not be to raise interest rates, rather would they be prepared to cut interest rates. And with the Federal Reserve in that spot, it would be very hard for other central banks to do anything else than to stay put themselves. So we do expect that central banks are likely to keep their interest rates about unchanged, perhaps working more with their balance sheets. And at the end of the year, we should be expecting the Federal Reserve again to inject liquidity, because there are tight spots that we know which tend to be quite seasonal. And so really it comes down to saying, well, if you take areas like the Eurozone or my home country, where interest rates are not only low, they're actually negative. If investors are holding cash, they're paying for the cash. They are not receiving any interest rate, they're paying for the benefit of having cash. In that circumstance, we believe it continues to make a lot of sense to be invested and to have a portfolio of financial assets that, of course, have to be very well diversified. So we do believe that a good starting point has to be a multi-asset strategy that gives investors the three sources of what every portfolio needs to bring, which is income, growth, as well as diversification and protection. These are the three things that practically all asset classes can be classified in terms of what they bring to a portfolio. Let me speak first to income generating assets. And traditionally, government bonds, and generally speaking bonds, fixed income, take that role in asset allocation. What I'm showing you here, however, is the percentage of international sovereign bond markets with negative yield. And if you take a look at my home country, 100% of all Swiss Confederation outstanding government bonds are yielding negative interest rates. So effectively, if an investor is today considering to buy those and hold until maturity, this investor knows for sure that he will have lost money at maturity. The only reason why people would do that and buy it, it's because it acts like an insurance policy. Everybody here is very familiar with insurances. We pay a premium in order to have the protection of our house, of our effects, of our cars, etc. Well, government bonds in core sovereign markets act exactly the same. They are actually a diversifying, protecting element, but no more a source of yield. And so we have really brought the weight of these assets to quite low weights, because they are not anymore there to provide income, they are there to provide protection, and instead to provide income, we have focused on bonds with credit risk, where I'm showing you here the three big categories of those bonds. Investment grade credits, these would be good quality corporate bonds, but their yields are very low, and so they're not going to bring a lot of income to the portfolio either. And then there is high yield corporates, so speculative, highly leveraged corporates. In the past, they used to have very attractive returns, even as recently as 2016, when we had issues in the US shale market. A lot of these shale companies are issuers on high yield markets. Yields have been very attractive, but look at what has happened over the past 2.5 years. Those credit spreads have collapsed to levels that are now very comparable to those of an emerging market benchmark bond, but the average credit quality of high-yield speculative corporate bonds is single B. The average credit quality of emerging market benchmark bonds is double B, and we are paid the same spread. So the risk-reward really has not been so attractive, and we definitely think there is one sweet spot in credits at the moment, and that would be emerging market bonds. I would say that if we anticipate global interest rates to remain very low, it really gives access to new issuers in emerging markets. And I want to speak to this audience about what I would call frontier markets, new issuers on international capital markets. And these frontier markets include examples that are familiar to you, like Egypt, that has been issuing more debt recently, but also Central Asian economies like Uzbekistan, for example, also now coming to the international capital market to fund some of the growth projects that they are having. And I could go on and cite you the examples that make up this index. The interesting point about it is that it has the same single B credit quality like the high-yield corporates that I spoke before, but it has credit spreads of about 460 basis points, which is about 100 basis points more than high-yield corporates. So for us, this is an interesting area that we think investors have to get more familiar with. Certainly in Europe, where perhaps they are not as close also to those issuers, but this will increasingly be a topic in emerging market investing as well. When we think about income, it is not only fixed income, not only bonds. Actually, real estate is a very attractive, well-known source of income, whether in direct terms, owning property, getting rental income for it, or in indirect terms as well, investing through REITs or real estate companies on listed markets. The dividend yields are shown here, for example, in Europe, because this is the area where there is just simply no bond yield interest rate that is worth speaking of, and where real estate provides a real alternative. So we do think of real estate as an integral part of a well-diversified portfolio, but I have to say increasingly equities as well are providing sources of income through the dividends that they are paying. In many instances today, the dividend yield of a company is much more attractive than the bond yield the same company is offering on bonds that they're issuing, whether it is in new issuance or even ones that is now trading on the secondary market. So it provides a source of income. It is equity, which means that if the market continues moving up, it is also participating in a rally. But the good thing that many investors are very sensitive to is that in phases of downturns, when the equity market goes through volatility and sells off, it tends to sell off less because it has this buffer provided by the dividend yield. So over time, dividend-paying stocks of companies that have good payout histories tend to be very well-performing stocks if the dividends continuously get reinvested. Let me now, as I'm speaking about equity, take the normal nature of equity investments, which is to really invest for capital growth, to actually get wealth to increase. And as far as this is concerned, at Credit Suisse now for the last 3 years, we have been investing a lot of our time and effort to focus on what we think are the key topics, the key themes that go beyond just how is the cycle and the business going to be next year, over the next 3 or 6 months, and actually speaks to needs that are very structural and that come from deep societal change. We have called these high conviction themes the super trends, because they're part of something more deeper that is going on in global society. Let me take for you 1 or 2 examples in there. Whatever the global economy is going to do today, next year, in the next 5 years, there is one demographic trend that will hold on inevitably, and that is population aging. Today, this is not only a phenomenon in Japan or in Germany, in Switzerland, it is a phenomenon that is very quickly coming to emerging markets as well. In China, we are already past the peak of active population, and the population is aging at a very fast rate. So what this impacts in terms of the pharmaceutical sector, in terms of the insurance sector, because rising healthcare spending that will come with population aging will have to be funded, and it's not likely to be funded by governments because they already have a lot of debt. It's going to be funded by individuals paying insurance for their life insurance, for their health insurance, looking to get annuities for the retirement phase and so on, as well as, frankly, the consumer and the real estate implications of a population that is aging very fast. I also have worked a lot, and we were the first ones at Credit Suisse to focus on another demographic phenomenon, which is the taking over of the new generation. If we can call them the millennials just for simplicity reason, and take together what is often referred to as Generation Y and Generation Z, so these are all the people below 30 years of age worldwide, this cohort represents already more than 50% globally. And this generation is, like every generation before them, very special. It has characteristics that are their own and that have been shaped by how they have been brought up, the environment in which they grew up. The millennials are completely digital. They're disrupting areas because of that. Just take a look at what retail has been going through and is still going through as a result of e-commerce. They will similarly disrupt the autos sector, because this is a generation that is extremely worried about climate change, environmental issues, etc. Disrupting the way mobility is likely to take shape for them, and it will in time even disrupt sectors like power generation, because they are focused on renewables and on a number of sources and aspects about power generation. So we have focused on the sectors that actually benefit from that. A lot has to do with technology, and I will be speaking to you about one of our most recent brain children, which is what we called edutainment, the combination of education, entertainment, and actually technology. Let me give you the story behind that. There are 2 sectors which have seen in the last 30 years costs explode. Can I just make a quick survey of the audience what these 2 sectors would be? Would anybody like to volunteer? Please. Education, second one, healthcare. So education, if I take the US example, has seen prices of education grow by about 5 times the average inflation of the US economy in the last 40 years. So it has become completely unaffordable, which is one of the reasons why the average student in the United States has about 40,000 US dollars on average of debt when he or she starts their professional life. And if they have done the top schools in the United States, that would be more than 100,000 US dollars in debt. There is a problem with education, which is that there are not so good results in terms of the graduation as well. So just the ex cathedra old style education has not been very effective in a number of countries. And then next to the cost, the lack of effectiveness, it is a fact that today most people would have to continuously educate and upgrade their skills as they work already, and this becomes a continuous education journey where people cannot stop working, go to university, upgrade their skills, and then go back to their jobs. This doesn't work. They want to work and at the same time take their upgrades of classes that become more and more officially accredited. And of course, the answer lies with technology. These are now digital classes and courses that are offered digitally. They are embraced by more and more schools in the United States and internationally. And I would also say this is not only a story of the United States. If I were to tell you that today the biggest market for language courses online is actually China, then you can see why we anticipate this market, the digital education market, to grow to about 400 billion US dollars in the US alone in the next 5 years. Just to put that in perspective for you, this is 2/3 of Swiss GDP in the space of 5 years. And we're very excited because we do believe it provides a true answer to some of the challenges that we see in that particular sector. I do want to say just a word on Kuwait equity market and just put into perspective here the valuation of the market, which is at the upper end. I mean, anybody that takes a look historically, but also in comparison to other countries in the region, understands that at 20 forward PE, it is a market that tends to be at the higher end of valuations. But if interest rates are likely to come down next year, if we are going to have the perspective of integrating the market into emerging market MSCI, something that Saudi Arabia, for example, has done in the course of this year, then I suggest that these valuations are likely to be sustained. And it will take probably interest rates again being in a phase of moving up to actually challenge some of those values. Let me say a few words now on commodities and then conclude my discussion. This is the oil market for us, very much a demand-supply market where supply adjusts extremely rapidly to demand. And what is happening as a result of oil prices that have increased is actually supply and production has been going up. We are likely to see over the next 3 months effectively production growth rates exceed those of demand. And that typically is a circumstance where oil prices, at least on the spot market, tend to come down a little bit. So if you take a look at our 3 months oil forecast for WTI, we do see $50 US. And for 12 months, we do think that there is likely to be a stabilization as demand and supply get again more balanced at around 55 for WTI. Gold has been a commodity that held up the whole of the year. it is a very strongly diversifying asset in a portfolio because it correlates with about nothing else. It has its own determinants, which are effectively the US dollar and US real interest rates. Why? Because gold is listed in US dollar and it has an opportunity cost, which is the US real interest rate. And so if US real interest rates come down, gold is just simply shored up. We believe that if the Federal Reserve is doing what we expect, namely staying put for next year, then gold is likely to be quite resilient, and we do forecast 1,500 the ounce over the next 12 months. As far as currencies are concerned, I'm showing you a few numbers, and we can take those perhaps in the questions or discussion that follows, but we do believe that the euro dollar is likely to remain in a relatively tight range. At the moment, of course, the Federal Reserve has cut interest rates, but what has happened is that the rest of the world has done also monetary expansion. So effectively, it is very difficult to have a catalyst for the dollar to depreciate in such a circumstance. But when you take a look at the long-term trend of the US dollar, I have to say, over the last 40 years, the dollar did only one thing, and that is to depreciate. So I do believe that investors in their portfolios have to think about the erosion of US dollar assets through the currency over the next 5 years. And the catalyst really is very difficult to forecast. It could be the US elections at the end of next year, depending on who the candidate is that makes it to the White House, and of course what the economic policies are that will follow as a result. Please also note, I think in the introduction there was a reference made to Brexit and the UK, that we do anticipate Brexit to happen in an orderly fashion after the elections, under the assumption that Boris Johnson is the winner of those general elections. And in these circumstances, the pound is among the very cheap and undervalued global currencies at the moment. It is likely to get back to its fundamentally justified value around 140 in 12 months, in our view. I leave my comments on currencies at just those two. I'm very happy to take any questions that you may have on those or any of the aspects that I discussed or otherwise. In the meantime, thank you very much for your attention. Thank you.
Thank you, Dr. Nanand, for the valuable information and topics. It's an extremely amazing subject. يا اخوان اذا في اي احد عنده استفسار it's time for a Q&A. تفضلوا الكتان. اللي يبي يسال سؤال بالعربي نقدر نترجمه بالانجلش. فخذوا راحتكم.
Yep. So just for reference, the yield curve inversion, especially for the United States, is when short-term interest rates, for example, 3 months or 2-year interest rates, are above the long-term interest rates, for example, 10-year government bond yields. And this has happened at several instances this year. First, between 3 months and 10-year, and then afterwards, which is, in our view, more meaningful, from the signal it gives for the economy, between 2-year and 10-year. In the meantime, I have to say it has normalized again. So obviously the long-term interest rates have come back up from the lows that they were in August, and the yield curve between 2 and 10 years is not inverse anymore. What has been very interesting about it is that in the past, inverted yield curves were regarded as good leading indicators for recession. So everybody got nervous in the summer of this year when this happened, because in the past it would be a good indicator that over the next 12 months there would be a recession. However, we aware of the opinion that here the bond market actually was too negative. I think that the steepening, as we call it, of the yield curve since the summer is likely to continue into the next year. Because on the one hand, central banks are unlikely to change anything to short-term interest rates. They're likely to stay, as we call it, well anchored, while inflation might actually surprise to the upside and push long-term bond yields up. So I don't believe in yield curve inversion. I don't believe in a recession around the corner. I do think that this was a misjudgment of the economic resilience, and I think that in the next 3 months, in fact, industrial production is likely to rebound, to recover. There are many one-off reasons why it was so weak in the last quarter of this year, probably going to trough in December. And as this rebound in the manufacturing sector goes, it tends to have a very big impact on the yield curve, steepening it and acting as a catalyst. So this is what I have to say on that phenomenon that has been indeed an area of heated debate among economists and indeed of a lot of concern among investors with regard to what it means for the global economy.
Dr. Abbas, تفضل.
شكرا. First, thank you to the Kuwait Economic Society for inviting the speaker, which is actually very interesting. And also thank you, Dr. Nand. I am pleased actually to hear such optimistic outlook and view, and I agree if we are incorporating the political factors in the analysis, there are a lot of political dimensions in what's gonna come, especially in 2020. Now, given the history of the current boom in the United States, from 2009 until now, it's almost 10 years or beyond that. If one look at the previous recessions that the world has during the 9 experiences, usually with the expectation that recession start after a few months when the return for corporates start to decline. The expectation is that this is going to happen between 3 months after the decline in the return up to 24 months. So if we talk about that return is start declining after June or July of this year, and so we are expecting a recession either in this November, which is not possible now with given all the factors, the political factors in the States, or up to November 2021. So in that, can we really now, given all the political factors that we do have, can we really just overlook this possibility of having a recession probably in 2020 or 2021? Though I agree, like taking the political factors into account about the optimistic view. Thank you.
There are 3 catalysts for recession in general. One is interest rate increasing because monetary policy gets tighter. Do we see the risk of that next year? I would argue no. After in 2021, definitely. So after the US elections, yeah, that could be a risk that we should note. The second avenue for recession or catalyst tends to be people that cannot service their debt. In the United States, yeah, students have difficulties, but in general, savings rates have gone up, labor market is good, so that's not a problem for the United States. In other countries, people do not have so much private debt as in the United States either, so that's not really a reason why we would have to anticipate a recession next year. And the third is when corporates are having too much debt. And there I would tell you, if I was having a traffic light, that traffic light would be on yellow, not red, because it's not at extended levels, but it has been increasing because when interest rates are very low, it's an incentive to take debt, even for corporates. So this is one of the reasons why I think I don't expect central banks to put monetary policy tighter. I don't expect really yet those levels of debt to act as a credit event. I think the risks for 2020 are very low, with perhaps the exception of, Germany. If it has on average 0.4% for the whole year of growth, it can very well be that for a quarter or two it has negative growth rates, and that would qualify as a technical recession. But for as long as you don't have unemployment that is increasing, I really don't consider this more than a technical issue. What is going to be interesting is what happens for 2021 and beyond. So typically when we do models to get an estimate of probability of recession, we tend to forecast up to 5 years. And our probability is increasing over a horizon of about 3 to 5 years, more significantly. This could then be the case that interest rates increase over that period. It could be the case that indeed the credit market sees credit events. So everything I talked about in terms of catalysts could very well happen over that time horizon. I think that the US elections outcome could potentially be the start of that, because it depends a lot about the economic policy that the United States will do, who is going to be in the White House. Let me take an example. If Elizabeth Warren is the person to, for example, come to the White House, she has very strong views on a number of things, including the shale sector in the United States. If she was to impose a ban or a partial ban on fracking in the United States, that would go like a snowball effect, because it means that certain states are going to see the unemployment rate go up as companies go out of business. It means that consumer sentiment, I told you about consumption that is contributing more than 70%, consumer sentiment would be deteriorating. And then that could not only affect the real economy, it would also have an effect on the high yield market, because about 10% of the US corporate high yield market is shale companies. So that could be the start of a more negative outlook. If you think about Donald Trump in the White House, and in fact it has been historically rather the case that the current incumbent of the White House, provided that the economy is doing well and the US equity sector is doing well, gets re-elected, well, then we could actually have another very supportive measure for the economy. Let me just dream a little bit about a Donald Trump that is such an intuitive politician. And I'm not making the, how should I say, the beating his drum, but he is intuitive and he understands what are the issues. Let us just assume for a moment that suddenly in his campaign, he borrows from Elizabeth Warren the idea to cancel US student debt. Did I talk to you about US student debt, right? If he were to do that, he would have all the swing voters among the young thinking, well, he got it, let me vote for him. And that would be another very big boost to consumption in the United States. So you could end up with, of course, the dark side of that is that the budget deficit is rising at a very fast pace under this Republican White House. And at one point, I was talking to you about what would start for the dollar to get weak. That could be the instance. So a re-election of Donald Trump, for example, could very well start the depreciation of the US dollar. So these are just a few scenarios, but I think that illustrate well what I think was your point, to understand where the risks coming from and over what time horizon should we expect them.
Mohammed, تفضل.
Yes, thank you for a very convincing presentation. However, I have a question about China. You know, the Chinese economy has been export-driven economy for a long time. Do you think it's possible to transform it to consumer-oriented economy, taking into account that the Chinese society is an aging society now, and also there are many regions in China that are still underdeveloped, and the standard of living in many of those regions has not caught up with the national level of standard of living. So it seems that the Chinese economy also is going through difficult times with the credit situation. They have so many people with heavy debts, many institutions, many government institutions also are heavily indebted. So I don't think the Chinese economy can flourish without having an open world economy, because they still have many export to deliver to the other parts of the world. So this is the question about China. The other question is about our region here. As a professional observer, do you think that we can restructure our economy from a rentier economies to productive economies, economies that depends on its resources, especially human resources, when we are still suffering from backward educational systems, and there are also a lack of political will of changing the current economies, which are heavily dependent on government spending, to economies that depends on the private sector, on the knowledge of human resources. So I would like to hear from you as an outside professional observer of what's going on in this part of the world, especially that the oil prices, as you mentioned, is not going to be great, you know, in the coming years. I don't think that they will get to $100 as some politicians are hoping for. Probably $60 is going to be the range that we should consider for a long time. Thank you.
Thank you, Mr.
Thank you very much.
I think the second question will help the government for the plan, for doing the planning. Yeah.
Let me take one after the next, and I think these are very important topics. So, with respect to China, I completely agree with you. In fact, if I were to tell you that half of the world's manufacturing jobs are in China, then it is very easily understandable that China needs the global economy and the global market, because all of this industrial production is not only for itself, it is effectively for the world economy. Which is also why I believe that China has always returned to the negotiation table, whatever tweet was coming out of the White House, whatever next surprise was happening. There is absolutely an interest, in some sense, to retain the access to the world market, because it just means a lot of jobs in China. However, China absolutely has the power to become a consumption society and market of the future. And I also suspect that Donald Trump's certainly long-term goal is to ensure the access for US companies to that growth market. Let me give you a sense of how wealth has increased in China over the last year. We do at Credit Suisse publish a wealth report, a global wealth report, every year that is tracking how average median wealth, but also very wealthy segments have evolved around the world. And China is really standing out as this one economy that has created a middle class and middle income wealth. So Chinese tend to have high savings ratios. Everything that they put aside is ending up in their wealth that is fructifying. So when you put together a very populous economy that is climbing up the income and wealth ladder, then you end up with a very powerful spending, which on top of that is now being supported by reforms by the government to take care of old age retirement solutions, not only in urban centers, but also in rural centers, in order for these Chinese to release their savings into the consumption. And finally, if I also share with you that some of the most innovative e-commerce solutions, where e-commerce has a penetration in China that is the highest of the world, with more than 20% of sales happening over the internet. When you take a look at European or other emerging market countries, I don't know how it is here, but it's more like 5% of global sales. Then you can see how China is already, in some sense, set up to have consumption go through the whole country because of logistics and because of the development of its digital platforms. So I believe it is a very, realistic outcome to expect. I don't say that it's only going to be consumption and they will, in some sense, be very hard in the negotiations, etc., because of my initial comments. There's too much of jobs in China that is still industrial production, but they do also want, for geostrategic reasons, to be more self-dependent and less dependent on the business cycle of trading partners. Because even if there was not the trade war with the United States, in 2008 and 2009, when there was the recession precipitated by the great financial crisis, China was the first to see what it means when your demand is breaking away from you. So that's to your first point. I am very convinced. I think that this is going to be a multi-year process, but I do believe that this is not only what they strategically want for their country in terms of how they're set up, but also what they're doing in terms of the policies to get there. Now, on this region here, and some of the visions and the understandings that just have, I think, to take place when at least I come from the outside and take a look at what is happening in the world and how this is mirrored and reflected here in the region and perhaps even here in this country. Then I think that the transformation of the global energy provision is something that this region has to be very mindful of. It is not to say that oil and gas are going to disappear. It's just not feasible. It's just not feasible because the demand for global energy is rising on trend. It's going to continue to rise. This is what populations that get richer are demanding. But there is a number of areas where this will be accompanied by a lot of investment into resources, into renewable energy, and I think that there has to be a vision of the country, of the region, with respect to the future world that is going to have a power generation mix that looks very different, and that over time may actually require to have technologies that mitigate the climate implications, so carbon emissions, to be very concrete. And I think that this is a discussion, at least from where I'm sitting, that I think is not going on in the region at the moment. People feel, oh, these are the Europeans that are talking that, you know, nobody else is. But I think that this is underestimating the consensus that is in the making in the international arena. With respect to education and productivity, which was part of that question of what does the region have to focus on, it is also undoubtedly the case that technology, productivity, and also here population aging will require these economies to become more productive. And so attracting talent in those areas, giving access to education that is top-notch in technological areas absolutely is part of what also the Middle East will have to invest, next to having a balanced source of income themselves, or a little bit more balanced than what we have now, which means that a number of countries, for example, have been really developing services sectors, like tourism, like financial sector, and everything that is part of the service sector. So I think that, in fact, a lot of what China is doing with an absolute determination can also be applied in many other countries and regions, including in this one, adding on top of it, because it's an oil-producing region, the necessity to look in the eye the regulation changes that are happening internationally with respect to carbon and fossil source of energy. Coming to the oil price now, in more specifically, it is a fact that the oil sector, the traditional one, has been underinvesting. And if I am again to come back to my US election scenario thing, if we were again to take the scenario of Mrs. Warren in the White House, the stopping of fracking in a number of regions of the United States, and underinvestment everywhere else in production capability of oil, then the oil price could actually surprise to the upside. This would be like a supply shock that could bring oil prices back to $80 the barrel for WTI. It could. However, what's the likelihood that Mrs. Warren ends up in the White House? Don't know.
Thank you.
So, thank you.
في أي سؤال يا أخوان قبل لا نختم؟ دكتور أحمد تفضل.
Actually, my question was the first one. هذه المشكلة. Goes to the point which you have kindly mentioned about the cyclical phenomenon prevailing in the Gulf countries. As far as the Kuwait economy is concerned, they are fighting it through counter-cyclical, through the capital expenditure, which consists about 17 of the total expenditure. To what extent you think the Kuwait economy can fight the cyclical phenomena through this policy, fiscal policy, and the future of capital expenditure, increasing capital expenditure in order to stabilize the economy? The outlook of such policy. This is question number one. Question number two, you have kindly mentioned the economic situation of different world economies, mainly China, and the rate of growth around 6% according to the last report of IMF in October. But to be very specific, I mean the main countries which have influenced the Kuwait economy is the main importer of oil, Kuwaiti oil. China, South Korea, India, Japan, and Singapore. Can you elaborate on the economic situation of these countries? Because these are the drivers of the Kuwait economy as far as the current situation is concerned. Last question regarding the private consumption as a led growth. And you have mentioned the case of United States, 70% out of GDP. Kuwait around 42, 43. Is the comparison is valid or not? Because as you know, most of the consumption in Kuwait is imported, not the case of United States. Can we build on these indicators as a positive one, or there are many reservations? Thank you.
Thank you again for this very broad area. So on capital spending and capital expenditure, I think, and I didn't go into the details of it, but it's another of the super trends and very high convictions that we are having. There has been underinvestment in infrastructure, to be very specific when we speak about capital expenditure, around the world since the great financial crisis, meaning for the last 10 years. The infrastructure spending gap has become so big that catastrophes are happening. I mean, last year it was very prevalent in Italy with the bridge collapsing. As recently as a few weeks ago, the same happened, not in the same dramatic extent, but still costing a life in France. Infrastructures in developed markets are just dating back to the Marshall Plan of after war in Europe. They have come to the end of their life cycle and need a lot of renewal, not only in transportation. In fact, there is still no rail that is going from the north of Europe to the south of Europe. There is still the need to even declog urban centers where there is traffic jams at peak hours everywhere, not only in Europe. Take emerging markets. I mean, there's a reason why in Egypt there has been basically the delocalization of the whole administrative center to a new city. This is, by the way, what humanity has done, the whole history of humanity. When something became, not good, we were creating a new place, and so it would flourish and provide a solution. Water infrastructure, power infrastructure. If I talk to you about the changing of the renewables, if it is really serious that we are going to reduce carbon emissions in order to try and limit global warming over the next 40 years, it means that renewables will represent 40% of global power generation. And it will mean that nuclear is going to grow in percentage, probably from currently 10% to about 15% at the very least. I mean, if I'm looking at what Russia has as ongoing nuclear projects where they are building nuclear power generation plants all the way from Finland to Bangladesh, then these are 28 only for this year. And if you think about China, they are adding 6 to 9 nuclear facilities, power generation plants every year for the next 10 years. Okay. So that is meaning capital expenditure until no tomorrow. And this is why we are particularly interested in the infrastructure spending. We think that it's likely to focus, as always, on transport, on power and water. Water scarcity is an issue. This is a region that I don't even have to talk about it, and you know what I mean. But also telecommunications, 5G. Is an infrastructure that will be rolling out because people will need to transmit so vast amounts of data that the old infrastructure is just not going to do it anymore. So communications infrastructure, and to end with, I don't know about this country, you will perhaps be able to inform me, but around the world, housing has become unaffordable for many people. In fact, for the young generation in particular. In Germany, which I know well, in cities like Berlin or Munich or others, rents have increased by 60% over the last 10 to 15 years. People are just not able to afford their housing anymore. So I absolutely believe in this trend of capital expenditure. I believe it's going to be big. I think there is going to be support. I mean, even Mrs. Lagarde, who is now a central bank president, but also Mr. Carney, who has been the first central banker, very criticized for it, but that has started to speak about climate change and what it means, are all likely to be in the same boat funding those infrastructure and capital spending, because it may very well mean that the ECB in the future is going to buy green bonds in order to fund all of these changes. This is one of the biggest growing markets at the moment, the green bond market. And I could go on. I mean, China is, of course, the biggest infrastructure spending machine of these last 10 years. Let me now move to your second question, which is the outlook for China, Japan, South Korea, and Singapore as some of the main trading partners of Kuwait. Japan is stuck in a low growth area now for decades, and it is very much part of the demographic development that has happened in Japan, which is population aging. When you have a population that is growing old, there is just simply falling demand for consumption, and if this is not being compensated with migration, growth rates just go down, inflation goes down. People are still very, very comfortable and they're living very well, but it's not going to be a very big growth country. China, of course, is also aging, but is at a very different stage where there is still a lot that is taking place, in particular on the consumption side. I do believe that China is going to remain a growth engine for the next 10 years of annual growth between 5 to 6% in real terms. As goes for South Korea, this, I think, is an economy that is more in the camp of Japan, so very low, structurally quite, how would I say, rigid, but also, frankly, I mean, I could nearly, it's very different in nature, but it's like Italy, in fact. It is completely as if stuck. And then Singapore, this thriving small economy that I think is doing very well, but is of course quite a small economy. So of all, I think that China is certainly the growth market of the future, and I think that India is a very important market, but India, as you know, is very different from China. I mean, India is one, much more domestic oriented, so they try to produce everything in their own economy. As far as their, just to be very specific on oil and the oil sector, India is of course importing all its fossil energy. At the moment, in terms of its electricity production, is very reliant on its own coal mines, but it is transitioning and is among the countries that has done best with respect to its objectives on renewables energy. It is very fast investing in renewable energy. So I think that, you know, India has perhaps been a side market for now, and may also continue to be a side market because it is making choices that are domestic driven and towards renewables. And therefore I'm left with, I think, good old Europe, where on the one side, I mean, they are dependent, they are not producers, they are also in an energy transition, they want to diversify, they feel they are too dependent on Russia, so, you know, this may very well be one region that also, by the way, I mean, the US are targeting with their own shale oil. So that's to your second question. And the last one, which is which is centering on how private consumption is here in Kuwait and representing 40% of GDP, and on top of that, actually meaning a lot of imports rather than domestic production. I think that this is always the case for oil-producing and commodity countries. I mean, they're running a current account surplus in some sense because they are exporting all this oil, and they're importing a lot for their consumption. It is, something that we see in very many places similarly. So I don't think that we should be taking necessarily the model of Europe or most other non-oil producing economies as one to thrive to. I rather think that here it has to be more about diversifying the economy and the sources of income in order to have a much better balanced sector-wise growth. One where the private sector absolutely has to continue driving innovation, because otherwise you may very well be ending in a spot where Germany is. They have sat on their great strengths of the last 15 years. Somebody could say, well, Germany has been this great nation of engineers. They sat on their industrial production expertise, and they missed, in fact, the train of technology. So I think that this country has absolutely to focus on diversifying the sources of income and sectors, and the private sector is playing a very big role, as well, of course, as the support from the public sector to engage in that.
نختم اليوم دكتور نانا. Thank you very much. It's a pleasure to have you here in Kuwait Economic Society. اخواني الحضور شكرا. قبل لا انهي احب اشكر اخوي فهد الابراهيم الام دي حق الويلث مانجمنت في كريدت سويس اللي ساعدنا لترتيب هذا الايفنت. شكرا اخوي فهد على هذا. شكرا اخوان الحضور، ما قصرتوا. Thank you.
Thank you very much.